And I'm Mira.
Usually when we look at the financial markets, there's usually a single dominant theme for the day.
Right.
Like a narrative you can easily just point your finger at.
Oh, absolutely. Usually it's pretty clear cut.
Yeah. But today it felt like we were watching two massive, just unstoppable tectonic plates violently colliding in real time. Because on one side, you have this soaring, almost existential anxiety over technology valuations. And then slamming right into it, you have a literal $100 a barrel oil shock coming out of the Middle East.
Yeah, and I mean, that collision left some really heavy damage across the board today. The S&P 500 dropped just over 1.2% to close at 7,408.30. And the tech-heavy Nasdaq, that saw an incredibly aggressive sell-off.
It was brutal.
It really was. We watched it dip as low as 28,432.50 intraday before it kind of settled a bit at $28,731.00. We also saw Wall Street's fear gauge, the VIX, spike up to 18.70, and the 10-year Treasury yield, I mean, that surged to 4.73%.
Right, which is just a massive amount of information to process. And that is exactly why we're doing this deep dive. Our mission today is to unpack this entire sequence of events for you listening. We're going to break down the overnight escalation in the Middle East that officially closed the Strait of Hormuz.
Which is huge.
Massive. And then we'll explore exactly how a surprisingly tight U.S. labor market, along with some weak Treasury auctions, completely spooked the markets intraday. And finally, we'll dig into the absolute eye-watering artificial intelligence CapEx numbers coming out of Alphabet and AMD.
But before we jump into all of that timeline, just a quick reminder for you, this deep dive is strictly for market context and discussion. So while we are analyzing the macro environment, this is not personal investment advice or, an investment recommendation.
Exactly. All right, so let's get into session one. What set the stage before the U.S. session opened today?
Well, everything was completely dominated by what happened overnight in the Middle East. So on July 22nd at 4:40 p.m. Eastern Time, we saw U.S. forces complete their 12th consecutive night of retaliatory airstrikes across Iran.
Right.
And in direct response to that, the Islamic Revolutionary Guard Corps struck U.S. missile defenses in Jordan, and they launched drones toward Kuwait. But honestly, the absolute most critical piece of news for global markets was the IRGC Navy officially confirming that the Strait of Hormuz remains closed to transit.
And we really just need to pause here and emphasize the sheer mathematical scale of that closure.
Right.
The Strait of Hormuz is this massive artery for the global economy.
Oh, without a doubt.
When it's pinched shut, you're halting roughly 20% of global physical oil and natural gas shipments.
Yeah.
It is not just a minor disruption, it is a fundamental choke point. And the market reacted exactly how you'd expect to a sudden supply shock like that. Brent crude spiked 7% to settle at $100.62 a barrel, and U.S. WTI crude surged to $92.33.
Yeah, and you can really see this through the frame of geopolitical escalation as game theory brinkmanship.
Well, I mean, I actually always struggle with how the market digests this kind of news, right? Because it bothers me that the financial sector has this tendency to treat these geopolitical strikes like they're random natural disasters.
Oh, like they just happen out of nowhere.
Exactly. They react as if a hurricane just unexpectedly hit a major refinery. But it isn't random weather. If we actually apply that game theoretic lens to this, both Washington and Tehran are methodically controlling their steps up and down the escalation ladder. They're telegraphing their moves.
Right.
It's highly calculated brinkmanship. Even though the macro impact of a massive supply shock is entirely real.
That's a really crucial distinction. It's calculated. But, the issue is that the physical reality of the oil market, it doesn't care about diplomatic signaling.
No, it definitely doesn't.
A closed strait is a closed strait.
Yeah.
And that physical reality was compounded even further shortly after the Hormuz announcement, when the situation spilled over into the Red Sea. So at 5:11 p.m. Eastern Time on July 22nd, Houthi strikes actually hit a Saudi-owned commercial tanker, the Insilia.
Wow.
Yeah. And in response to that direct hit, Saudi Aramco immediately began rerouting their crude cargoes all the way out of Egypt's Mediterranean port, Sidi Courier, just to avoid the danger zone entirely.
Which completely feeds into this idea of energy shocks as multiplicative supply inflation. Because if you're a massive commercial tanker and you suddenly have to detour around an entire continent, you're adding thousands of nautical miles to your journey.
Right. Your transit time literally doubles.
Yeah.
So do your costs.
Exactly. And rising freight and insurance costs just ripple through the entire global economy, which, of course, creates a massive headache for the central banks.
It really does, and we actually saw that play out this morning. At 8:15 a.m. Eastern Time on July 23rd, so just before the U.S. Open, the European Central Bank held its benchmark rate steady at 2.40%.
Right.
But the actual rate hold wasn't the big story, it was the commentary. ECB President Christine Lagarde explicitly cited the Middle East conflict as an, quote, alarming risk. She essentially warned that this massive energy shock severely limits their ability to safely cut interest rates.
So we have a completely closed Strait of Hormuz, $100 oil, and effectively trapped central banks heading into the U.S. Open. That wraps up session 1. When we come back, we'll look at how U.S. economic data and bond vigilantes reacted during trading hours.
All right, moving into session 2. What moved markets during U.S. trading hours today?
Well, the primary catalyst dropped right at 8:30 a.m. Eastern Time with the U.S. initial jobless claims report. The consensus forecast across Wall Street was looking for 210,000 unemployment claims.
Right, that was the expectation.
Yeah, but instead, the number unexpectedly plummeted to just 187,000. I mean, it was a severe miss to the downside.
And we really should explain why that's actually making the stock market so nervous. Because despite all the recent headlines about tech sector layoffs, this report proves that the broader U.S. labor market remains incredibly tight.
Exactly.
And that strong consumer resilience means wage pressures just aren't fading, which forces the Fed to keep rates restrictive to cool things down.
And the bond market heard that restrictive message loud and clear today. At 1 p.m. Eastern Time, the U.S. Treasury held a $21 billion auction for 10-year Treasury inflation-protected securities, or TIPS.
Oh, and that auction did not go well?
No, it didn't. It was incredibly weak. The auction tailed significantly, clearing at a really high yield of 2.438%, with a very weak bid-to-cover ratio of 2.30.
Which brings up that whole concept of long-end yields as deficit and war risk premium. Investors are looking at the sticky geopolitical inflation fears, and they're demanding a much higher premium to hold U.S. government debt. That weak auction sent 10-year Treasury futures sliding, which pushed the actual yield up to that 4.703% level we mentioned earlier.
I do want to jump in here and just offer a little bit of pushback on this, though, because it's very easy to look at those soaring yields and assume the corporate world is collapsing. But we need to look at credit stability signaling a non-systemic duration shock.
Okay, unpack that a bit.
Well, if you look at high-yield corporate bonds today, like the HYG ETF, it dropped to 79.15. That is a yield and valuation shock for sure. Money is getting more expensive. But it is not a broad corporate solvency crisis. The companies themselves are fundamentally healthy.
Right, it's a repricing of risk, not a wave of bankruptcies. That's a great point. But, moving from the bond market back to stocks, there was another heavyweight dragging on the market today. At 6:01 a.m. Eastern Time, the European Union slapped Google with an €890 million fine under their Digital Markets Act.
Oh, yeah.
And in response to that, the U.S. Trade Representative publicly demanded a ceasefire.
And that kind of heavy regulatory friction, especially when it spills over into open diplomatic hostility, just added a lot of extra weight to the broader technology sector's sell-off during the day.
So to wrap up session 2, we had soaring treasury yields, an uncomfortably hot labor market, and mounting regulatory tech pressure. We're going to take a quick break. Next, we'll recap today's massive corporate capex news and tell you what to watch next.
All right, let's dive into session 3, corporate events recap and what to watch next. What is driving this tech valuation anxiety?
Well, the main course for that anxiety actually started yesterday, right after the closing bell. At 4:02 p.m. Eastern Time on July 22nd, Alphabet released its second quarter earnings. Right. And honestly, on the surface, the core business is performing exceptionally well. Search query growth is incredibly solid, and they noted that their Gemini models are processing a staggering 22 billion API tokens every single minute.
22 billion a minute. That's just wild.
It is, but the market completely hyper-focused on one single thing. Alphabet substantially raised its full-year capital expenditure forecast to between $195 billion and $205 billion.
And here's where it gets really interesting and honestly completely jaw-dropping. It's not just the $200 billion they're spending this year. Alphabet quietly disclosed that their future spending obligations have soared to $811 billion.
That number is almost impossible to comprehend.
It is nearly $1 trillion committed to physical infrastructure. And it really brings up this frame of AI capex as a self-defeating valuation loop. I mean, you have to question whether these massive physical infrastructure costs are just completely undermining their digital valuations before any clear AI monetization even arrives.
Yeah, they're building the factories before they know who's buying the products. But, while Alphabet is bearing the brutal cost of buying all those servers, other companies are reaping the direct benefits.
Exactly.
For instance, at 12:38 p.m. Eastern Time today, AMD held its Advancing AI event. They unveiled their new Helios AI server rack and their next-generation Venice CPU.
But the hardware specs weren't even the most crucial part of that event. The real impact was the endorsement. OpenAI's infrastructure chief actually revealed they are deploying the AMD Helios at a massive scale.
Which is huge for AMD.
It completely validates them as a formidable alternative to NVIDIA, which up until now had basically monopolized the space.
Exactly. Now, rounding out the corporate news, we had two late-breaking stories hit right after today's 4 p.m. Eastern Time closing bell. First, Intel reported a pretty disappointing second quarter. However, they announced they still plan to heavily boost their 2026 and 2027 capex for manufacturing equipment. And additionally, the Trump administration announced sweeping 10% to 12.5% forced labor tariffs on several nations. This includes India, though they explicitly exempted oil, gas, and food.
And just a quick impartiality check for you listening. We're simply reporting the facts of this tariff policy and the potential supply chain friction it might cause. We aren't taking any political stance on the trade strategy itself. We're just looking at how markets have to digest it.
Right. It's just another macro variable to track.
Okay, before we look ahead, I think we need to stop this serious analysis for just a second to try and cheer up our battered tech investors.
Oh, boy. What do you have in mind?
Well, let's appreciate the bright side of Google's eye-watering $811 billion future capital spending commitment. Right. Sure, your portfolio took a hit today, but at least you know your money is funding enough hot AI server racks to physically heat your house this winter.
Oh my gosh.
I mean, with Brent crude surging over $100 per barrel, those scorching new GPU server farms might actually be our cheapest heating alternative. So, don't let today's closing bell get you down. Your returns aren't gone. They're just temporarily rerouting around the Strait of Hormuz.
Wow. That is certainly one way to look at it. Okay, let's quickly run through what you need to watch next over the next 24 hours for tomorrow, Friday, July 24th. First and foremost, keep your eyes on any overnight developments in the Strait of Hormuz and the Red Sea. That is paramount.
Definitely.
At 8:30 a.m. Eastern Time, we get second quarter earnings from American Express and Verizon. Then at 9:45 a.m. ET, S&P Global releases the flash July U.S. PMIs. At 10 a.m. ET, we get June U.S. new home sales. And finally, before the open, watch for SLB's Q2 earnings, which is a vital read on the energy sector.